Hare Krishna. Welcome to Tax YouTube channel. This is your own R. Pingre, practicing chartered accountant based in Mumbai, also partner in Motilal and Associates LLP, member firm of Marks Network. Welcome to the video series What Law Says. And today we are going to discuss two important case laws, one reported to the ITAT level and one reported to High Court. So let's dive into it. Let me allow to share my screen. Yes, so let's directly start with it. Our first case, ACIT versus Everwin Educational and Charitable Trust, Chennai Tribunal. Relevant assessment year is 2016-17 and date of order very recent again 24th February 2026 and relevant section is section 13 subsection 1 clause C and section 13 subsection 2 clause G of the Income Tax Act 1961. Let's understand facts of the case. The assessee is a charitable trust engaged in educational activities. It was registered under Section 12AB and claiming exemption under Section 11. During the assessment proceedings, the assessing officer observed that transaction with related persons, that is specified persons, allegation was trust funds were used in a manner benefiting the persons covered under Section 13 subsection 3. So assessing officer invoked section 13 subsection 1 clause C, that is denial of exemption, section 13 subsection 2 clause G, use of trust property for the benefit of the specified persons. Very interesting. So let's see what were the issues under consideration. So issues were whether certain transactions with the related persons amounted to direct or indirect benefit, thereby violating section 13, leading to complete denial of exemption under section 11. So what are the relevant legal provisions? Section 13 subsection 1 clause C, which deals with exemption denied if income or a property of the trust is used for the benefit of specified persons. Section 13 subsection 2 clause G deems violation where income or a property is used applied for the benefit of the specified persons. Section 13 subsection 3 defines specified persons, that is trustees, founders, or relatives, substantial contributors. Okay, that is the thing. So moving further, let's see grounds of appeal. So revenues contention was transactions were not at arm's length. Indirect benefit was provided to the specified persons and therefore entire exemption should be denied. Whereas assessee contended that transactions were genuine, at reasonable value and for furtherance of the objects of the trust. So no real benefit accrued to the specified person is what contended by the assessee. So let's see what tribunal observed and held. Tribunal observed that mere existence of the transactions with a specified person is not sufficient. Mere existence of the transactions with a specified person is not sufficient. It must be go beyond. For invoking section 13, there must be clear evidence of benefit or diversion. So if transactions are at arm's length for legitimate purpose, then section 13 is not tractated. So what principles laid down by this case? Substance over form approach. Arm's length transactions are permissible and burden of proof lies on revenue. So not every related party transactions triggers the section 13. Very important. So moving further, let's move on to the case 2. CIT TDS versus National Highways Authority of India. Madhya Pradesh High Court. Relevant assessment year is 2009-10. Date of order 6th March 2026. Very recent. And relevant sections are section 197 and 201 of Income Tax Act 1961. Let's understand facts of the case. The assessee government authority, payments made to the contractors or vendors. Vendors have obtained what lower or nil deduction certificates under section 197. So AO treated NHI as assessee in default under section 201 for alleged short deduction of the TDS. So issue was under consideration whether payer, that is NHAI, can be treated as assessee in default when payments were made based on the valid Section 197 certificate. So, relevant legal provisions here, Section 197 deals with allow recipient to obtain lower or nil TDS certificate. Section 201, that is payer deemed assessee in default for payer deemed assessee in default for what? Failure to deduct or pay TDS. So let's see grounds of appeal. Revenue's argument was certificate was incorrectly issued, that is misapplied. Deductor still responsible for correct deduction. Whereas assessee argued that relied on a valid certificate issued by the competent authority and no fault or negligence on the payer behalf. So let's see what High Court observed and held. So the High Court emphasized that Section 197 certificate is what binding on the deductor. Deductor cannot question the validity of the certificate. Very important. Please note down this. When the Section 197 certificate is issued, it is binding on the deductor, and then deductor cannot question validity of the certificate, has no authority to reevaluate the tax liability. So key judicial reasoning is that if deductor acts in good faith based on the valid certificate, then it cannot be treated as assessee in default. Means very important point to note to here is that deductor cannot question the validity of the certificate, has no authority to reevaluate the tax liability. So principles laid down by this case is Section 197 certificate is a conclusive for the deductor. No liability if reliance is bona fide, and responsibility shifts to the tax authorities issuing the certificate. So no penal consequences without fault. So thank you so much for patient hearing. If you have any questions, observations, suggestions, then do let me know via WhatsApp or email, or you can also comment below the video. If you are not yet subscribed to Tax YouTube channel, then do subscribe for latest updates and video series like this. Hope you are gaining valuable knowledge from all these updates and video series which we are conducting on the Tax YouTube channel. So stay tuned to the Tax YouTube channel. Thank you so much once again. Bye bye. Take care. See you soon. Hare Krishna.